Welcome to the ASX edition of Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the ASX 200. I'm also going to cover gold and uranium, so make sure you stick around for that. I'm going to look at the S&P 500 in a separate video. I'll leave a link for that in the description section below. And I'm also going to tell you about an event which you can come along to, meet me and listen to me talk about markets. So I'll tell you about that in a moment. So again, make sure you stick around. And as always, general commentary doesn't take your personal situation into account. With all of that said, let's get into our first chart. So I've got the ASX 200 up on the screen, and it really has been an interesting couple of weeks. So about a week and a half ago, we got this strong rally off the base of this Fibonacci region, and broke above some previous high points. So that was all looking encouraging. Didn't stay up there too long, quickly about faced and came all the way back down to where it started, actually a bit below where it all started. And the media coverage over that week was all very much about how that was the ASX 200's worst week in months, and it all sounded pretty gloomy. But it's interesting though, when you step back and you actually look at the price action in context to everything else that's been happening, it's really just volatility within a range. Nothing has really changed through this period since mid-April, where we're just tracking within a range, and there's volatility within the range. Nothing unusual or uncommon about that. So I don't think there's been any great technical damage. In fact, I like that the market did find support at the base of the Fibonacci region around these previous lows, and has had a nice rebound during this week. So I don't think there's a whole lot of damage, and we are range bound, but there are reasons to be optimistic, I think, about this market. This trend line, which I drew in, I'm going to remove that now. It wasn't a trend line of great significance. It was more to emphasize this series of lower lows that the markets had. So as we saw a couple of weeks ago, it didn't act as a resistance point. And it doesn't serve to show us the series of lows, lower highs anymore. So we'll take that out. Instead, I think the area to watch now is this resistance band, which comes in at around 7,390-ish. So just picks up a few high points, and of course the high from a week and a half ago. So that's an area to watch at the moment. But still, this market is just lacking direction, and until we get some clear direction, it remains a range-bound market, and there's not a lot to do when a market is range-bound. Trying to fight range-bound markets is usually a good way to just chop up some capital. It's the fact remains the local market hasn't been running with the US market. It's also trading right on these moving averages. So we're really waiting for a rally to kick in, which can gain some traction. This did look encouraging, but it didn't maintain traction. It slipped all the way back down. So we need to wait. We need to wait until we get a definitive breakout. A break below these lows from earlier in the week and a few weeks ago in May would probably open up some more downside. And likewise, a break above this resistance point will most certainly open up some upside. So let's just wait and see. Having a look at, I thought it was interesting to have a look at the All Ordinaries. I'm looking at a weekly chart just to put some perspective around where things are with this market. And I think overall, this has been a painful 18-19 months. But it is generally constructive when you look at it from a weekly perspective. So markets don't move in straight lines, as we know. Big rallies like we saw off the COVID low, and this was a large rally. This wasn't your ordinary rally. It's one of the strongest rallies we've seen in the ASX. There are other periods with very strong price action, but this is up there. This is up there with the strongest periods. And it naturally does require some sort of consolidation of that move. And that's what we've been seeing here. It's been encouraging that the All Ordinaries has actually held on to a big part of this move. Now, how long it needs to track sideways, that's the big unknown. But it isn't unusual that it has been tracking sideways for 18, 19 months now, given the extent of the rally. And when we just compress this a bit more, look, I think like the rally off the GFC low, strong rally, and then there was a period from October 09 through to August 2011, or potentially you could even say January 2012, which was just a difficult period. I think we're getting that equivalent period now. And ultimately, though, I think that this can provide a launching pad for higher levels. But it could still take time. We just don't know how long it's going to be. And we can't be certain that that's going to happen. But I think that's how the cycle continues. We have the up moves, we have the sideways, and we have the up moves. That's how it tends to work. So let's jump to the small orders. And interesting in that this really is a similar version of the Russell 2000 in the US, although it's a weaker version in that whereas the Russell is currently trading above the moving averages, the small ords is trading below its moving averages. The moving averages are actually starting to trend lower. But we are within a range, and it's not unusual for markets within ranges to be below the averages and then be above the averages and just keep trundling sideways, creating what we call whipsaw in portfolios, where you're entering positions on breakouts, the positions fall back, you hit your stop losses, you get out, and then back up they go again. That's the whipsaw. That's what makes the trading range a difficult and unimpressive environment to be in. But bases or trading ranges often lead to excellent trading conditions. You just got to wait for the main break to occur. I still think this could be a big basing formation, just compressing this a little bit. The rally from the COVID lows, big decline. Now it looks like it's potentially maybe some sort of it could be a rounding type of base. We need to wait and see how it plays out, and it's just being patient, waiting for those opportunities to present. And we know this lackluster ranging period will end. It's a matter of just waiting it out. It will happen. And now, if you're getting some value, please hit that like button. Leave a short comment. Just, hey, thanks for the video. That helps me heaps because YouTube will then show other people. Hit the subscribe button if you haven't already done so. And if you haven't done so, come and visit me at motiontrader.com.au. Let me say that again, motiontrader.com.au, and see if the work that I'm doing with trend analysis and portfolio management, risk management might be able to help with what you're doing. And it does help to be able to get ideas that you might have otherwise considered. So come and have a look. Now, let me tell you about what I'm doing in a couple of weeks' time, which might be really interesting to you. So I'm going to be presenting at Think Markets, the stockbroker. Think Markets are having a traders summit, and they've asked me along as one of their speakers. So it's in Melbourne, so this probably works best for those who are in Melbourne. We're going to be at the Marriott. It's on a Saturday morning, Saturday the 22nd. Free to come along. It's going to go for 2 hours, and here we are. This is of course this is me, and so I'm going to be talking about trend analysis, trend following, risk management. 40 minutes I'll be speaking for. Kel Butcher, he'll be talking. He specialises in foreign exchange. He'll be talking about his processes can help you access the currency trading. And Carl Capolinga, I think Carl's a fantastic analyst. I really love the stuff Carl does. And Carl is from Think Markets, so he'll tell you a bit about Think Markets, and he'll tell you a bit about the way he approaches the markets. I think you might find it really interesting. So if you're in Melbourne and you've got a couple of hours spare on Saturday the 22nd, I'd love to meet you. So maybe come along to that, and I'll leave a link. I'll leave the link in the description section below, so you can get to this landing page. It'll be in the description section. Just send me an email if you can't find it. Now, moving along to markets, gold. It's gold is now below these moving averages. The moving averages initially gave a little bit of a bounce off the 100-day, but it's now rolled over. The moving average seem to be rolling over as well. I don't think this is a time to buy gold. I don't think, we've been talking for weeks now about the excitement period in gold probably being over, and that continues to look to be a case. I don't think it's the time to buy, but look, just keeping it in perspective. Let's go to these weekly charts. Weeklies are really good at putting things in perspective. This was a big rally. This was a big rally that we had off the lows in 2018. Gold basically doubled over 2 years. So big rallies, and this is what we were speaking about earlier with the All Ords. Big rallies require big consolidations. That's what we've been having. And I still favour that this is going to ultimately be the launching pad for much higher levels in gold. But that could still take time. I really do like this, the likeness to this period here. These things never play out exactly, so we can't use as a roadmap. That sort of thing doesn't work. But I just like it so much for just sort of like trying to explain the concept, in that a big rally led to a lengthy consolidation, and then a large rally. I think the same sort of general price action could play out again. It's you're not looking for, as I say, that roadmap type scenario, but just that general understanding of price action, that we go up, that we zigzag our way sideways, and then we get ready, we get prepped for the next move, and then up it goes. I think that's a real possibility to keep an eye on. So, but look, again, trading ranges, it's just what makes this business difficult, because the market doesn't move on our time frame. It moves on its own. So we just got to keep watching, got to keep waiting, got to stay in the game, and not get bored, not get frustrated, not go somewhere else. And eventually you do get these big moves, which can be great. Having a look at copper stocks, I really do like the copper stock story, and this remains interesting because the price seems to be coiling up. It's been coiling up since around January, so it's also above support. You can see this support. This is the US listed Global X Copper Miners ETF, so COPX. There's an Aussie equivalent. The code is WIRE, wire. But I look at this one because the price action, there's more price action. It's been listed a lot longer. So it's an interesting one to have a look at. My hesitation to sort of starting to establish some sort of position now is just looking at copper. It's copper's below the moving averages, and it's below a resistance band at around $4. It's it's another one which had a big move. Look, if you think back to 2020, 2021, people were talking about like how much copper it was going to take to make electric cars, and everyone was like, go copper. But things don't go in a straight line without any pauses. And again, big movers required a big consolidation. It's just where we are within the consolidation now. Is it ending and we're getting close to like a move back up above this resistance, or does it have more to play out? I really don't know, but looking at those copper stocks is interesting how they're coiling. If they break to the upside, well, maybe that's worth running with. And just lastly, I'm going to quickly finish off with uranium. It just hasn't been able to close above this resistance band. So this resistance band, which I've been, it's a broad resistance band. You can't. It's not a real nice clean one where you got these exact touch points. But it's a band which I've been using for quite a few months now, and price never was able to close above it. Well, now we're pulling back down. We're back within the range, back to the moving averages, and inside this contracting range, which the price had so encouragingly broken out from. So look, maybe this has been a false dawn. Maybe it's uranium's not ready to go at the moment. It's too early to say for sure. It could stabilize here and then rally again. Just looking at Cameco. Cameco's holding its breakout and has rallied again. So look, uranium may do the same. But look, as I always say, if something's not working, you just don't need to push it. If it's not working, if an idea is not working, you get in, it's not working, you just fall back, let it go, wait for the next opportunity, because the opportunities do come, and you just don't want to be fighting it. If it's not working, it's just not worth fighting. Now, just on, we've talked a bit about ranges today. Just on ranges, like we're looking at this range here and going, oh geez, when's it going to break? Surely it's got to break up at some point. Surely this is it. But just on these ranges, just think back to the Nikkei. Now, the Nikkei had been in a big range for many months, and for all we know, uranium's at this point here. It's testing the top of the range. It's going to pull back. It's going to muck around for a bit longer. But then when the Nikkei actually broke out of this range, and we spoke about this about a month ago, once it actually broke from the range, it just went crazy. It has taken off in a very big way. Now, that doesn't always happen when a range breaks, but it can happen, and it could happen with uranium. That's why I say be patient. If it's not working now, fall back and potentially wait for the next break. And it's look, it's going to be interesting to see how it plays out. And look, let's leave it there for this week. Thank you for joining me. Been really good to talk. If you're in Melbourne, come along to this seminar in a couple of weeks. I'd love to meet you. So until next week, thanks for joining me. Bye for now.